Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, I heard that you were spurred on to look up something that was very
yeah. So what happened was I was on the internet, as I often am, and I was witnessing a debate between some very, very intelligent people about whether stocks are riskier in the long run or they're not riskier in the long run. In other words, do they get less risky if you invest for a long period of time? But that debate, though, was less interesting than what somebody else mentioned, sort of as an aside to the debate. And this was an anonymous commenter, so I can't give any credit here. But the person said, well, look, you know what, to be real honest, it doesn't matter that much for most people. And he said, this is why. Most people, like take somebody who's, let's say, 25 and they're going to retire at 65. Most people do almost all of their investing during the 10 years before retirement. In other words, they put in so much money from 55 to 65 that it practically dwarfs whatever they experienced as an investor from 25 to 55. So he said, really, what you guys are arguing about, you know, because it's a statistical matter, and if you look at it one way and you talk about investing one way, it depends on how you look at it. But he said, okay, but let's look at it in the terms of the way that real people really usually invest. He says, it doesn't matter because most of what really matters to people is going to happen in that 10 years between 55 and 65, because that's when they're pushing all of their money in.
Right. Well, I can see that because a lot of times their kids are out of school, they have more money.
Right.
They're in their highest earning years at a job.
Yep. And they're getting worried about it.
Panicking.
yeah.
Panicking for retirement.
Right. Yeah. So what I thought about when I was thinking about this was something that we've talked about many times before, but you know, well, okay, there's two things. I mean, the first thing is that, you know, for anybody watching this who's not 55 yet, who's 35, you know, this is one of the many good reasons why if you can manage to invest some little, you know, significant portion of your money now, you can really get ahead of the game, because then you're not completely dependent on these, you know, 10 years right before you retire. But the other thing is, you know, for most people who are not really in a situation to go back in a time machine and redo things, this brings up one of the many reasons why we talk about diversification around here. I mean, the first thing is, I don't know, the first thing is, you know, a while ago I did a little study which showed that if you diversified into small and value and these other asset classes, there was never a decade, you know, from the 30s, the 40s, the 50s, there was never a decade when you lost money in that portfolio. Right. Whereas there were several, or at least 2 decades, I think 3 actually. No, there were 2 decades where if you just put all your money in the U.S. stock market, you lost money. Right. And so, you know, I was thinking about that, but then I was thinking, you know, also we often recommend that people put some bonds in their portfolio. Right. So, and then I was thinking, well, maybe if you cherry-picked like the worst year you could possibly, you know, the worst year to start a 10-year investing, what would happen? So what I looked up is I have a little computer program, and I looked up, you know, and this is just a portfolio that's split into large stocks and small stocks and just U.S. stocks. So nothing fancy or nothing complicated, not even as diversified as what we use. Right. But what I found...
You could do this portfolio anywhere.
Yeah, exactly. Right. But what I found is that throughout all of history, there's never been a decade, no matter when you started it, when a 50-50 portfolio lost money. So in other words, half in the stock market and half in the bond market has never lost money. Even more interesting, there's never been a decade where having 75% of your money in stocks and 25% of your money in bonds lost money. Wow. That's never happened. Again, this is only with minimal diversification, just using large and small stocks. And I can't even study it using international stocks, but you know, just this small amount of diversification, which is not that complicated, which you don't even, again, need to go to us to do, this really benefits you when you're concerned about, maybe I don't have 40 years to wait for this to work out. So then the next thing I looked up is I decided to find out basically what I found out was that I took it down to 9 years and then to 8 years. Okay, if you go down to 7 years, then finally for both a 50-50 portfolio and a 75-25 portfolio, you finally get a period of time where you lose money. Sure. But if you go back to 8 years with either one of those portfolios, so essentially, as long as you have a big chunk of money in bonds, you know, any big chunk of money, and as long as you have a big chunk of money in the stock market, for any 8-year period, and as long as it's minimally diversified, you wouldn't lose money.
And the bonds should be not the long-term bonds.
Yes, exactly. These were just treasuries, you know. Okay. Now, of course, there's a trade-off. if you only have half your money in the stock market, obviously you cannot do as well as the market does when it goes up.
Right.
Even if you have 75% of your money in the stock market, you can't do as well as the market. And if you diversify the way we do into international and into small and value and microcaps and all these other things, then there are going to be decades like the 1990s where even if you have 100% of your money in the stock market, in a diversified portfolio, you won't do as well as
it's
the market
still very
does.
robust returns.
Yes, exactly.
Yeah.
And the point is, if you're like most people, you can't afford to take the risk for even 8 years or 10 years that you get really terrible returns. Because for most people, whether it's the right thing to do or not, the way they actually invest makes it necessary that they get at least decent returns over any moderately sized time frame, 8 years, 9 years, 10 years.
Right.
So I thought that this was a very interesting thing to look up, given the way that, it's just true, we should just accept this, given the way most people actually invest, to look up, okay, so how well has diversification done over some shorter time frames? And I think that it's an excellent way for anybody who, part of, I think, being a financial advisor is to set expectations. Someday there's going to be a bull market where the market does wonderfully, and our portfolios that we recommend merely do very well.
Yeah.
And I'm going to tell you guys right now, this is why we invest doing things that merely do very well.
Right.
Because you can't afford to take the risk of something really bad happening if the opposite thing occurs.
Right. So what I'm taking away from this episode as we conclude is that actually that it is likely that the majority of retirement investing often occurs in the last 10 years before they retire.
Yep.
And if you use that as your time frame, a good mix of stocks and appropriate fixed income is not particularly risky.
Well, yeah, exactly.
Yeah.
And I think that's something that if people are worried about what they're seeing in the media or whatever, forget about it.
Yeah.
Media's not there to educate you.
All right. Well, that's very good, Lauren. Thank you very much, and we'll see you next time on Erickson TV.
Yeah, see you next
Bye now.
time.